Welcome again to our quarterly webinar hosted by CoBank's Knowledge Exchange team. As usual, I'll start off with some brief commentary on macroeconomics, and today we have a special guest, world-renowned ag economist from the great state of Illinois, Farm Doc. You may recognize him. Gary Schnitkey, and he's going to tell us about Corn Belt economics this year and what to look forward to. And then our CoBank grain and oilseed economist, Tanner Ehmke, is going to talk about the wheat situation. So we got macro and Corn Belt and wheat all in one shot today. So with that, I will get going here. So the past few years, 3 years, really, all I've been talking about, I give 20, 30 presentations a year, and it's been all about inflation mostly. But in the past couple of months, finally, I would say the inflation bugaboo has largely faded from everyone's concern. Now it's just a matter of how quickly the Fed is going to lower rates. And the CPI, the headline inflation, which includes all expenses, came out this morning, 2.4% year on year, which was the lowest in 4 years, I think. Now some people complain because the was maybe not quite as low as some had hoped. But as you see, over the past 30 years, I drew a line. Past 30 years, the average headline CPI is 2.5%. Today we're at 2.4%. So I would say by and large, the inflation problem has been set aside, at least. I think the Fed still has some desires. Things like shelter and insurance are still quite high. It's questionable to me how interest rates will help reduce shelter costs, obviously, because you don't build houses when it costs so much to get a mortgage. So the lower the interest rate goes, should spur more home buying and more home building. Generally speaking, the economy is now finally, safe to say, returning to a pre-pandemic situation where we're returning to long-term levels of spending growth for goods and services. So services is the red line, goods are the blue line, and you see if you draw those lines out to today, we're getting close to where the trend line would have been pre-pandemic. So the goods inflation, as you would guess, has been quite low, negative in some categories over the past few months as we slow down the growth trajectory on spending on goods. Now, consumer spending is now back in line with consumer income, which has to hold in the long term. But with the federal stimulus package and the inability to buy many things during the pandemic, sent these two measures completely out of whack. And for a couple of years that I've highlighted there in the yellow, inflation was completely out of control, and people were having to draw on savings, so they weren't able to cover their expenses with the biweekly paycheck, which makes people very nervous and unpleasant and very crabby. So the consumer sentiment and general atmosphere was very negative there. But now that inflation is back in line with historic norms, we're back to normal, I should say. Someone asked, do you have a cumulative inflation chart? Shoot me an email at the end and I can send that to you. Well, obviously inflation's been up 25%, 30% over the past 3 years if you want to do a cumulative. Consumer spending is about 65+% of the entire US economy, and this is monthly inflation adjusted, so real consumer spending representative of goods and services bought keeps on rising month to month. So this is a really good sign if the biggest chunk of the economy continues to strengthen, I would say. So as long as this holds, we're well uh, secured. There won't be a recession in the near term, but we need to keep an eye on it, obviously. And as I noted, spending is dependent on real income, so we need to monitor that situation as well. So, on the surface, things are cruising along quite well. This is the Atlanta Fed's estimate of current economic conditions. It's called the Fed GDP now, and it's gained tremendous credence over the past 3 years, I would say, because it continually outperforms the guesses of macroeconomists across the country. And it's continuously said the economy is doing better than what people think it is. And it turns out it's been much more accurate. So right now, Tuesday's was the latest estimate. They said the economy's cruising along at 3.1% as of today. That's fantastic. That's so much better than I think anybody would have thought at the turn of the calendar year this year. Now, just a note of warning. I'm not saying this is going to happen, but just found this interesting from Pantheon Economics newsletter that I get. The past 3 recessions that we've had, other than the strange pandemic situation, the initial estimate from the government, the official number, missed the start of those recessions, sometimes in a major way. So just for example, on the very left, back in 1990, the first estimate for Q3 1990 GDP, it was something like 1.7%. It was revised down. 3 years later, the government figured out we were actually contracting at that point in time. So they were off by two plus percentage points as to what the economy was doing. So I'm saying these numbers, people are way too eager to jump on the latest print numbers, and they're often revised. And there's so many different numbers coming. You have to pull back and look at things in a more comprehensive manner. Real income growth. I deleted the pandemic years because it's so out of whack, but the key point is we're still above long-term real income growth. So inflation-adjusted income growth is still above the long-term average, but it has come down quite a bit over the past 12 months. So are we going to level off near here, which would be fine? Or is this economy slowing and we're going to blow past the long-term trend in a negative way? There's some warning signs that people have been monitoring, and that's why the Fed cut 50 basis points back in September, is because they saw these warning signs as well. Job openings, or the JOLTS report number, is way below long-term trend. We had, up until last week, job growth or monthly additions to the US economy in terms of jobs had been slowing dramatically from about 300,000 at the beginning of the year to only about 150,000 in recent months. But lo and behold, last week in September, the September payroll number came out, blew everybody's expectations out of the water at 250,000 new jobs added. However, there's a big caveat there, which the market doesn't seem to be paying attention to. This chart, again, by our friends at Pantheon, shows that the response rate to these government surveys on jobs is continually declining, such that only about 60% of people or companies are responding to the initial request for numbers. Because of that, it takes multiple revisions, and the government, it takes longer for the government to eventually settle on what the actual true number is. And over the past 2 years, you see the chart on the right, those are the downward revisions that come through at a later date. So over the past 2 years, the average month has been revised downward by 50,000 head. So, that 250,000 we got on Friday additions more than likely is going to be revised by at least 50,000 downward. So people need to relax a little bit with this. And why is this so slow? It's the smaller companies are not responding. The large corporations, it's the automatic process, but these smaller companies takes them longer, and those are where we're seeing the job weaknesses in the small businesses. This is small business hiring intentions, and as you see, come um, come down quite a bit from recent highs to a long-term average level. So again, are we going to level off at this kind of situation, or will it continue to drop? Why is this important? Well, 60% of the labor force is engaged with small businesses, so it's been quite accurate in recent times. Quits rate, lowest in 10 years, so people are not quitting. Could signal that people are a little bit afraid of making a change, or they don't see great opportunities on the other side of the fence. So another sign the job market is weakening a bit. Now, unemployment rate had been trending up quite significantly by 0.5% or more. That could be because of increased immigration, which wouldn't necessarily show weakness in the economy. It would just show that more people are looking for jobs. And you don't have to be legally job eligible to respond to the survey to say, yes, I am looking for a job. They don't ask your eligibility or not when they do these surveys. Layoffs, permanent layoffs, have been actually trending downward the past 18 months. So that's a very good sign. So what's the Fed going to do? The markets say there's probably going to be 150 basis points in cuts by next summer. You don't have to really make heads or tails out of this. I'm just showing what the market probabilities are. If you look at, let's say, 6/18 of next year, so next June, slide across, the highest probability at 39.9%, the highest chance that interest rates will be at 350 to 375. So that'd be 125 basis points, and then a couple months later, another 25. The market today is showing about 80% chance of a 25% or 25 basis point cut in November and 25 in December. So another 50 this year. Now that seems like a good situation, but remember, just because the Fed cuts, that doesn't mean the interest rates that you see on Main Street and Wall Street will fall in conjunction. This chart shows the spreads over the Fed rate. And what we are is we're in a historically tight spread situation, and those should more normalize, particularly when if the economy is seen as risky, or particularly like if the agricultural economy is seen as kind of getting a little bit more risky, which it should likely be, those spreads are going to widen out. So, if the Fed cuts a total of 2%, actually at your business level, you probably are only going to see about a 1% reduction in interest rates. So don't get too excited. But the economy is doing quite well. I don't think anybody could be disappointed in how things have shaped out. We do need to watch the labor market. It is showing some mixed signals, but by and large, things are going pretty well. With that, we're done with macro, and we'll turn it over to the ag world and turn it over to Gary.
Yeah, thank you. We are going to go to the Midwest, and I'm going to take a look here in the next while at farm profitability, liquidity, and some of the upcoming decisions that farmers are going to have to make. This again is a Midwest focus. It's going to be primarily on corn and soybeans. And as you're going through this, you're also going to see some Illinois data. Um, we may not be the best at football, but we do follow corn and soybeans fairly closely. And the reason why I'm giving you some Illinois data in particular is because of our farm business, farm management record keeping financial service here, which gives us a pretty good breadth of feel for what's going on in Illinois. These slides these prices just show corn, soybeans, and wheat. These actually aren't Illinois. These are USDA market year averages, and as you can see for the 2024 year, we're coming up with a projection of 410, or USDA's Office of Chief Economist, 410. 1080 for soybeans, and those are considerably below the 2023, 2022, and going all the way back to 2019. And USDA makes a projection for the 24 marketing year, looking forward to the 25 marketing year. If we look at where futures contracts and forwards bids are, we don't see those changing much. So right now, we would be saying that we're back to lower prices, and that those lower prices could continue to be in the foreseeable future. To give you a feel for that from a longer run perspective, the 24 and 25, we're projecting a 1080 for 24, 1030 for 25. Those are actually reasonably close to the long averages from 2006 up till 2023. Generally, I and many ag economists view the commodity markets, corn, soybean, wheat, as being at a long run plateau till something changes that plateau, and that changed in the mid-aughts because of ethanol build and continued strong use of soybeans and our export demand from China. But as we're looking at this, we're back to those lower prices. And one item to note is we sort of went through this back in 2012, 2013, and 2014. And then we had another extended period where we're below those long run averages. And we could again be there now. The factors that would cause prices to again increase above those long run average are difficult to predict. Last time that happened was beginning in 2020, and it was a derecho in Iowa, the hog build in China, and a Ukraine-Russia conflict, along with the demand issues or supply issues more in Brazil and Argentina with droughts and floods. Whether that will happen again in the near future remains to be seen, but we could be at these prices for an extended period. Even though we're sort of back to average levels, we're going to see much lower incomes now than even what we saw back in 2014 and 2015, and that's because of higher cost. We track cost, and again, this is for Northern Illinois. All areas that we track in Illinois follow this. USDA follow these trends as well, and Finbin would show similar trends. But we saw large increases in cost again in 2020, beginning in 2020, reaching highs in 23. And we've seen a bit of a decline in 2024, mainly from fertilizer. But overall, again, we're at a much higher cost level than we were back in 2013, 2014, 2015. And we really don't see those non-line costs coming down much at all, except for fertilizers. And those fertilizers have begun their decline. We've hit highs on fertilizers in 22. And again, a lot of that was Ukraine-Russia conflict that caused those to be higher. We're back down from those levels. Having said that, none of the other costs that we typically look at are showing signs of going down. Seed pesticides continue to remain at the levels that they were 23 and 24. If anything, we're hearing that seed prices have increased a bit into going into 2025. Pesticides, again, haven't come down. And if you're looking at machinery related costs, those went up considerably and have not come down. So those higher costs then will cause incomes to be down. To give you a feel for that, now we're just in central Illinois. We're showing here operator and land return, and the blue bars are the cash return that goes to the farmer and landowner. And our projections would be that for 2024 and 2025, those will be considerably below where the average cash rents are at. We are projecting a reduction in cash rents for 2025. We are actually projecting a $20 decline, and that sort of follows what happened between 2014 and 2015. Again, and we will, it remains to be seen actually if those things happen. But if you're looking at this, you'll notice that there is a large negative number there. You can associated with cash rent farmland, even if we do see those cash rents decline by that $20. Again, if you're looking at that, we've made a suggestion of thinking about lowering cash rents, which may or may not happen, but thinking about getting back to the levels that we were at in 2020 before all the increases in prices and costs that we saw in those high returns. Whether or not that happens will remains to be seen. But 2020 levels still wouldn't get us a positive return, but it would be closer than levels that we are at right now. Again, we're looking at negative returns, and this happens to be cash rent farmland, again, central Illinois. I would expect this to be across the Midwest. Again, if you're looking at those, you'll see that 23 minus $93, 24 minus 101, and minus 62 for 2025. Those are again much lower than the -3 and -10 that we saw back in the 2014 and 2015 period.
Gary, I have a question for you if you can pause for a second. We have a question here. Why are machine costs going up and projected to not come down? Does this have anything to do with AI, autonomous tractors, big data, etc.?
All of the above, actually. Machinery, and again, if we're looking at Deere, Case IH, AGCO, their labor costs are going up. Other costs are not coming down, so you can't really look at those costs or machinery or new costs coming down. And if you look at history, they rarely come down. So from a new machine perspective, we're not looking at those coming down. And again, if you're looking at machinery repairs on farms, one of the largest problems in the Midwest and across the country is that finding technicians and mechanics is difficult. So you really can't see the labor situation where those repairs come down. So it's sort of, we got up there, and the fundamentals of it don't say to me that they're going to be coming down at all. So that then leaves fertilizer and cash rents. And typically cash rents don't come down that quick at all either. So we'll see where that's at. Maybe a recession will play into that, but we aren't really anticipating any declines in machinery-related costs, at least into 2025. If we see these, continue to see those elevated costs, we will. We have another question here. If cash rents return to 2020, pre-2020 levels, does that suggest land values correct with it? And you would expect to see some downward pressure on land prices, and we in the Midwest have begun to see those land prices stabilize and perhaps decline from some of their higher levels. Back in this period, 2014, 2015, and 2016, we saw slight declines in land prices. Again, though, you got to remember between 2020 and 2023, we went up considerably, just like cash rents did. So unless we have a pretty long and protracted period of lower commodity prices and farmland returns, I really wouldn't expect a large decline in farmland prices, but I would expect to see some softness in those land prices and some declines, but probably not back to those 2015, 2016, and 2017 levels. Again, there's a lot of financial strength out in the agricultural sector, and a lot of that was built because we did have high returns in 2021, 21, and 22. Again, this is Illinois data. USDA data would suggest the same thing. This happens to be grain farms. We had record incomes on grain farms in 21 and 22. That was caused by those higher commodity prices. 2020, we had higher incomes as well, and some of that was higher commodity prices as well as coronavirus federal programs, CFAP, as well as PPP and other things contributed to those higher revenues. We saw declines in incomes in 2023, 71,000 compared to 506,000, and we're projecting below a net income on average below minus $30,000 for this year. Again, those commodity prices coming down and those high costs contribute to that, and that would be lower than happened in 2015, and basically since we've been looking at this and probably going back to the 1980s. So, but there is this 2022 and 2021 incomes out there. And when we look at those farms in FBFM, and again, you look at USDA numbers for cash grain farms, you see the same thing. We have high current ratios on these farms. We had a 3.03 average, and at the end of 2023, that was down because inventories were down as well as incomes. And our average debt to asset ratio is very low. So there's a lot of financial strength out there to weather lower incomes for a period. We would be expecting, or I would be expecting, this current ratio to decline considerably. If you're looking at working capital, and grain inventories are going to be valued less at the end of this year than they were at the beginning, so we're going to see less of that. Overall, though, we do have financial strength. Just to give you a feel of the distribution of in FBFM, and again, this is pretty close to what we see here, but in other areas as well. But we have over 80% of the farms with less than a 0.5 debt to asset ratio in the large categories. So there will be financial stress out there, but we do have considerable financial strength as well. Now we'll be looking at cropping decisions coming up. Our budgets, and this again for Illinois, are showing soybeans having higher returns than corn. That actually has been pretty much often the case since 2014, when the ethanol build sort of reached its fruition, and we've seen soybeans have more or higher returns in the heart of the corn belt. So, but what we're looking at isn't anything out of the ordinary. So in the Midwest, we're probably not looking at sort of any major changes in acreage coming in, looking between corn and soybeans in the upcoming year. But just to summarize, Midwest grain farms will have low income in 2014. And unless something rebounds significantly between now and when we do ending inventory valuations at the end of 24, which could happen, not likely, but could happen, we will likely be looking at the lowest average in the last 20 or 30 years. Midwest farms, however, are in a very strong financial position, and they had very good incomes in 21 and 22. And how long this period is going to last, we don't know, but it could be conceivably a long period. I could make the case for a very long period, and we're going to likely need to see adjustments. And where those adjustments likely will be the largest is in the land market. And what will happen? What will be happening to cash rents? And again, that's usually a slow process. Farmers need to. Many farmers generally need to have some working capital issues before they begin to think about lowering cash rents. I personally would encourage looking at lowering cash rents, but it's a tight market as well. I've got a question. If farmers feel any financial stress, when are they going to sell their crops? So that's a good question. So that's a good question. By the way, it is 2024. I apologize. This slide should say 2024. That was a miscalculation, or miss on my finger when I put 2024. With that, I am going to turn her over to.
Hey, Gary, did you have any thought on that, when farmers might sell a little bit more aggressively?
Oh, I've got distracted there. You know, I would expect them. Now I'm just speculating. I think we're going to begin to see sales here even in this fall. The cash flow issues that have occurred will likely occur. That there's not a real. They're going to have lower income, so there's not a reason for a tax reason to do that. And you know, we have a lot of farms also that have held grain throughout for a very long time. And we're likely to begin to see that selling here in 2024. And I think also that farmers are going to begin to, the chance of higher prices or the expectations of that are diminishing by the day. So, yep, it's going to, I would expect that to begin even this year. So.
Okay, great. Thanks, Gary. We'll get to some further questions at the end of the presentation, but we'll turn it over to Tanner now to talk about wheat.
Great. Thank you, Gary. That was enlightening, and thank you, Rob. So we're going to take a look at the current situation as it is with wheat. We've obviously already have the new crop in the bin. That happened quite some time ago. So we're going to take a snapshot of where we are right now with wheat markets, with a forward look on where we are heading with the winter wheat crop that is currently being planted. So first off here, let's take a look at the global situation, as you can see on the chart on the screen. Look at the green line on at the bottom there. That is world stocks to use for wheat, excluding China. And the reason we exclude China is because China is the world's largest stockpiler of grain. But those are non-tradable stocks. They do not contribute to what is traded throughout the world. So we need to exclude the Chinese stocks to get a true view of tradable inventories around the world. As you can see there, this has been a story that we've been talking about for quite some time. It's starting to get a little old at this point. We are the tightest in world stocks to use since the year 2007, 2008. Back when prices had breached $12. The only time since then we had gone above that level is when Russia and Ukraine, when the Russia-Ukraine conflict began. That's when prices had rallied back above $12 a bushel. We've clearly come back since then, well below those levels. So one would be, many would be are scratching their heads. What's going on here? Why are we not back up at those higher levels? Well, the world prices are trading not just supply and demand, but the flow of money. As chief economist at StoneX, Arlen Suderman likes to say, prices are a function of supply and demand, but are modified by the flow of money. As you can see on this chart right here, clearly some of these macro situations around the world, like the value of the Russian ruble, help determine value. As the Russian ruble declines in value, and remember on these charts here, it's a little counterintuitive. When the blue line, which is the ruble, is going up, that means the value of the ruble is going down because the dollar is buying more rubles. So as the ruble weakens, that depresses world wheat prices. The reason being is that Russia is now the world's largest wheat exporter. They took that role some time ago, and so now with their ability to export, their currency in Russia matters more to world wheat prices. And you can see this negative correlation here. When the ruble is weakening, that sets a lower floor, if you will, on world prices. And here are those world prices right now. Look at the bottom of this table. You can see Russian wheat at 12.5% protein is now trading at $227 a ton. The only other location really that's comparable is Ukrainian wheat at 11.5% at $225 a ton. Now, there's been some conflict over in the Black Sea with a couple of Ukrainian ships being sunk that really hasn't caused panic in the marketplace. I think the market has gotten used to the fact that wheat will find other avenues outside of the Black Sea. Because markets will be efficient. Plus, Russia still has exportable supplies. Compare those locations in the Black Sea region to U.S. Hard red winter wheat at the Gulf, where we are priced at $267 a ton. That is $40 above not Ukrainian, but Russian prices. We simply are no longer the low-cost exporter anymore. SRW at the Gulf is 263. Argentine wheat is at 225. So U.S. origin is well above other world origins. Taking a look at our latest supply situation, our wheat stocks, this is all wheat classes combined, are the highest in 4 years. This includes on-farm and off-farm stocks. And this is because we had a much bigger crop. We had the biggest crop in 9 years. This is across the board. We had increases over last year for all wheat classes except for soft red winter wheat. That was the only class that saw a reduction from last year's harvest, and that was because we had a retraction in acreage. But hard red winter wheat on the plains, hard red spring wheat in the northern plains, white wheat specifically up in the Pacific Northwest, and durum wheat. It's hard to tell on this graph, that orange bar at the top of those bars. Durum wheat saw a fantastic increase year over year on production, and that altogether that lifted us to the highest level in 9 years in total wheat production. And we also had an improvement in yields, as you can see on that chart on the right. So that has enabled us to be a little bit more competitive on supply or on exports, despite our price disadvantage. You can see here on export sales. This is this morning's data from the export sales report. This is total commitments. So what has been shipped and what has been committed, or what is on the books waiting to be shipped. HRW export sales and accumulated exports for the current marketing year are up 54%, thanks mostly to Mexico. Mexico has been a very reliable export destination for us, for all grains, really, not just wheat. And you can see that there on that top left, chart. Hard red spring wheat sales are up there, up 12% year over year. Again, strong sales to Mexico and some other destinations in Southeast Asia and Eastern Asia, like Japan, Philippines, Taiwan. And then soft red wheat, those export commitments are down 17%. Again, that's because we had a much smaller crop than we did last year, so fewer exportable supplies. But you can tell there again, Mexico stepping up as a reliable buyer. White wheat up 48%. Again, it's the Southeast Asian story there, Eastern Asian story. Some very strong demand in those regions as well. White wheat. Now, moving on to what's happening in the countryside. It's been an interesting situation here that we've been monitoring. First, I want to talk about North Dakota basis. That you can see that green line trending as it does after supply comes in, and then basis weakens. Same story there for soft red. It's the yellow line. A little bit choppier trend though. Soft red wheat has had some issues there with basis being affected by low water levels on the Mississippi River. So it's been a little bit choppier there. But then you take a look at that top left chart. That's HRW basis in Kansas. Quite a bit more volatility there. We had some ongoing issues there with basis, with some new demand stepping in that distorted the market, or didn't distort the market, but it tightened the basis in Kansas. And then you had some grain buyers that ended up buying some very expensive basis, or basis that they normally probably wouldn't prefer to pay. And then that is resulting in some weaker spreads on HRW. This what you see here on the screen are the carries based on the DEES March spreads from December 2024 to March 2025 futures. Clearly, there's quite a more handsome carry there for Chicago wheat and Minneapolis wheat. So storage is paying a lot more there. This is something that elevators are thankful to have. Kansas City wheat, on the other hand, a milder spread there. And that's because for a number of reasons, some reluctance to deliver there because a lot of grain merchandisers bought some more expensive basis than ordinarily would like to have, so they're more reluctant to deliver. There's also some stories of lower protein in this wheat crop, so reluctance to deliver higher protein wheat in this environment. And so it's creating this illusion of tightness. And so therefore, the spreads have come in a little bit more for HRW compared to SRW or spring wheat. Now, of course, all it takes is somebody to deliver against these contracts, and then perhaps we'll be back to some wider carries. Now on to planting of the winter wheat crop that's commenced. As you can see here, we're dealing with dry conditions on the plains. That's not a surprise. I don't think Kansas can ever really catch a break here. Another year of dry planting conditions, but it's also spreading beyond Kansas. You can see Oklahoma, Texas, Nebraska, Colorado, eastern Colorado, seeing some dry conditions right now. But interestingly, we're also seeing dry planting conditions in the Midwest. You can see Illinois, Indiana, Ohio, Kentucky. You're starting to see dry planting conditions there, where the soft red crop is planted. And you're starting to see this show up in the planting progress numbers. The current progress numbers, this is data collected from USDA NASS, is that red dotted line, and you can see where we are compared to the 5 years prior, and we are clearly behind schedule. We started out probably at a normal pace, but now we are clearly behind prior years. Farmers are just simply waiting on a rain to plant. Farmers don't like planting into the dust, because if you do get a heavy rain, then that's going to compact the soil. It's going to create a crust over the soil, and when the seed germinates, it can't break that crust so easily. So farmers are waiting on that rain to plant into a moist seed bed rather than planting into dust, and they're still waiting. So there's some concern here that we may have some poor stands heading into fall if they do plant into the dust. What does this imply for acreage? Well, simply looking at the market, if you take a look at the Kansas City HRW contract versus the corn contract as a comparison, the HRW to corn price ratio is down a little bit. If you look at the chart on the left, that green line is showing that the spread in September is down from where we were last year. This would imply a slight decrease in HRW acres. Conversely, if you look at the Chicago SRW contract versus corn, you can see that yellow line is up slightly from last year and up slightly from prior years, which would imply a slight increase in SRW acres in the Midwest. We got some other issues around the world. Dryness in the Black Sea region. Planting is delayed there by about 11%, or the lowest in 11 years. So there comes some concern there. We might start to see some loss of acres if this historic drought in the Black Sea region persists through October and into November. Perhaps there may be some acres that go unplanted. Here in front of us, new supply will be new wheat supply will be entering the world market with the southern hemisphere. The main two countries there really that matter are Argentina and Australia. I didn't add those maps here on this slide deck, but we got some dryness issues also developing in Argentina, where the crop is in grain fill stage. Not good finishing weather right now. Then the same thing in Australia. We got dry conditions in Australia, and then also a recent freeze. And so there's some ideas here that perhaps as we round out 2024, we could be still tighter yet based on the stocks to use from numbers that we saw that I started with. So there's some ideas that if we really don't start to get some relief on weather here in the United States, in the Black Sea region, in the southern hemisphere, we could start to see prices on wheat really waking up around spring, when we start to understand the true nature of supply before we start before we start having next year's harvest around March or April, May, June, when the northern harvest starts coming in. So that's something to watch right now. As I mentioned, we are fairly tight globally, and right now the situation is lending itself to be set up for further tightness rounding out this year. So something we're going to be watching as we round out 2025. And with that, I'll hand it back to Rob for any other questions. I do see that we had some other macro questions come in, Rob, or perhaps some other questions for myself,
Okay.
for Gary.
Thank you, Tanner. Well, first off, let me comment. It's nice to see some glimmer of a bullish scenario in crops. It's been a tough go for the past couple of years, and if your numbers are true, then we could have a rally, in wheat, which could pull other markets as well. First thing, the presentation link will be sent out, I think, tomorrow, along with a link to the rebroadcast, if anyone is interested in that. We had a couple questions come in. One related to, essentially, is the stock market overvalued, and could that cause a recession? I would say the stock market is not overvalued. What is potentially overvalued are tech and AI related industries. Just take an example, NVIDIA has rallied over 200% this year, the AI chip maker. And that is pulling up some metrics that may show that the stock market, P to E ratios are out of line. Well, the problem is we don't know if the expectations and hopes that we're seeing in AI, if they come to fruition, then the stock market is not overvalued. If they don't come to fruition, then yes, obviously they are. I don't see any sort of trigger. It's nowhere near as overvalued by metrics as it was in the dot-com bubble, for example. So I'm a little bit out of date now, but there was a study a couple months ago that showed, maybe we could see a 8% pullback in the stock market to bring us closer to in line with historic norms. If that happened, I don't see that kind of wealth effect causing too much spending difference on the consumer. That most consumers aren't even in the stock market in any major way. So it would have to take something really calamitous, which would trigger a huge reduction in the stock market to really have an effect on the economy. So I'm not really worried about that right now. It may be a slow unfolding thing in the next few years if AI doesn't prove to be as profitable and as useful as companies are expecting. Oh, I see another question came in for me about, in the meantime, Tanner, there was a question just generally on ag commodities. Why did we see the big run up in prices if maybe the world stocks to use ratios didn't seem to warrant that?
Why did we see the run up in prices?
In 20, what was 22, 23, 21, 22, 23?
Well, a lot of that was driven by the conflict in the Black Sea with Russia invading Ukraine. That helped lift prices. And the dollar wasn't as strong at that point in time. And we were still exporting to China. And so the demand side of the ledger was a bit of a different story than what we're seeing right now. And then, we had some trouble, crop production problems in South America. So it was both a supply and demand driven scenario. You can go down any number of rabbit holes with each of the commodities for corn, wheat, or soybeans. But suffice to say, it was a remarkably different scenario than we're dealing with right now, based on the supply demand fundamentals on for either crop, and plus the fact that we had the dollar wasn't nearly as a problem then as it was right now.
All right, thank you, Tanner. Okay, so I got a question here essentially related to the job number, the would be payroll, increase, decrease numbers, and um, as it relates to government jobs, what does that mean? So you can get the job gains or job losses. You can get the breakout by industry, and the broader categories are, the 10 to 12 or 15 broad categories they report on, and you can drill deeper if you want. But the government category, actually the largest by far is your local and municipal jobs. Particularly what moves those numbers is school teachers, and if you could have some even big, like I remember Houston a couple of years ago, there was a situation with the Houston school district, and that it moved even the national numbers a little bit. So you can find those numbers. I read multiple macro reports every day, and they would certainly highlight if there was something strange going on with the government jobs in particular. Those revisions are largely due to the slow and increasingly slow response rate from all companies, small companies in particular. And in this economy today, the biggest stress, the people that are under the most stress are your small businesses, especially. They're facing on the street borrowing costs of 10% plus. So it's not too surprising that they're under stress. So it's those small businesses. The government isn't capturing the smaller than expected job gains from that category. And with that, all right, one more question I want to ask to Gary. Do you see any change in demand for land by outside or institutional investors in the next coming years?
So again, I would expect that demand to be reduced somewhat. Having said that, a lot of assets are going to be facing sort of the same pressures that farmland does. So, but farmland in particular, if we're looking at the returns coming down, that's going to put downward pressure on farmland prices, and it does make for outside investors that asset look less attractive. So, and we pretty much that expectation is something that is in the market out there.
All right, Gary. So with that, I'll wrap it up. I do want to put in a plug for Gary's employer, the University of Illinois Extension, and particularly what they call the Farm Doc program. Google up your Farm Doc Daily and subscribe to their material. They're the best in the business as far as university research. They put out, I don't know, Gary, what do you say, 10 different things a week come across my box?
Yeah, we
just loads of stuff. And it's national or regional related. It's not only Illinois stuff. So if you're not already a subscriber, highly recommend that you do that. And with that, thank you all you attendees. We really appreciate you joining us. Without you guys, we don't have a job. If you have questions, our emails are there. We always respond to them directly. And we'll see you next time. We have a meat-related webinar on Halloween. So if you're interested in the meat and poultry side of things, sign up for that. And thank you very much.